Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into some significant news from the Office of the Superintendent of Financial Institutions, or OSFI, as they explore replacing the current stress test with loan-to-income regulations. This is big news, Janine, as it could impact how borrowers qualify for mortgages across Canada.
That's right, Steve. The current stress test limits borrowers to a minimum qualifying rate of 5.25% or 2% above their contract rate. OSFI is now considering a shift to a loan-to-income model, which would align Canada's regulations more closely with those in places like the United Kingdom.
Exactly, and this shift is not just a proposal anymore. OSFI has already started implementing a portfolio-level loan-to-income cap for federally regulated lenders. This means the share of new uninsured mortgages that exceed 4.5 times a borrower's gross annual income is limited at the portfolio level. It's a significant change from the individual loan focus of the stress test.
Yes, and OSFI plans to evaluate this new framework until at least January 2026. They'll then decide if the loan-to-income model should replace or complement the current minimum qualifying rate. It's a cautious approach, ensuring any decision made is well informed by the data collected during this period.
Paul Gruel from Highclere Capital mentioned that this change aligns with a global trend towards income-based affordability. However, he also pointed out that the long-term impact on financial stability and housing affordability is still uncertain. There are potential downstream effects on home prices, buyer behavior, and market volatility.
And Joe Jacobs from Mortgage Connection raised concerns about potential short-term impacts, especially if both the loan-to-income and stress test were to be applied simultaneously. He suggested there might be an initial slowdown in market activity and possibly a reduction in buyers, which could affect price appreciation.
It's interesting to note that while most buyers who qualify under the current stress test might also qualify under the new loan-to-income rules, the transition phase could bring challenges. Jacobs highlighted that lenders might lose some flexibility in unique cases, like those with higher down payments.
Indeed, and Jacobs also noted that the minimum qualifying rate was effective when interest rates were low, preventing borrowers from over-leveraging. But in today's higher rate environment, the stress test might not be as suitable. He suggested a more dynamic approach that could adapt to different rate environments without being directly tied to income might be beneficial.
It's a complex situation, Janine, and as we move forward, it'll be crucial to monitor how these changes affect the market and borrowers. The balance between maintaining financial stability and ensuring housing affordability is delicate, and OSFI's decision will undoubtedly have wide-reaching implications. All right, Janine, let's turn our attention to the recent outlook for interest and mortgage rates. This week, the Bank of Canada made a significant decision regarding interest rates, and it seems the market is responding with its own predictions that could influence the debt many Canadians are dealing with.
That's right, Steve. The central bank's actions are closely watched because they set the tone for borrowing costs across the country. But as we've seen, the market's perception and expectations can sometimes diverge from the official stance, impacting how Canadians experience these changes on the ground.
Exactly. Amanda Lang had a conversation with Penelope Graham, the Director of Content at RateHub, about this very topic. Graham pointed out that the Bank of Canada's decision is just one piece of the puzzle. The market is also driven by global economic conditions and investor sentiment, which can lead to fluctuations in mortgage rates independently of the central bank's policies.
Yes, and Graham emphasized that while the Bank of Canada might signal stability or gradual changes, the market often reacts more dynamically. This can create a situation where borrowers might see shifts in their mortgage rates even if the central bank holds its rates steady.
That's a crucial point, Janine. For instance, if global economic conditions suggest inflationary pressures or increased demand for Canadian bonds, we might see mortgage rates rise, even without a direct move from the Bank of Canada. This underscores the importance for homeowners and prospective buyers to stay informed and flexible in their financial planning.
Absolutely, Steve. It's important for Canadians to understand that while the central bank provides guidance, the actual rates they might secure for mortgages can be influenced by a variety of market factors. This is where working with knowledgeable mortgage agents and brokers can really make a difference, helping people navigate these complexities.
And as Graham noted, the current environment is extremely murky, with potential for both upward and downward pressures on rates. She advised borrowers to be proactive, perhaps considering rate locks or exploring different mortgage products that might offer more stability in uncertain times.
That's a wise strategy, Steve. Staying ahead of changes and understanding one's financial situation can empower Canadians to make the best decisions for their circumstances. And as always, keeping an ear to the ground for updates from both the Bank of Canada and market analysts is key.
Moving on to our final topic today, let's delve into the current real estate market conditions in the Waterloo region. Recent data from the Cornerstone Association of Realtors has shown a concerning trend with sluggish sales despite a rise in housing inventory.
That's right, Steve. It appears that economic uncertainty is playing a significant role in keeping potential homebuyers on the sidelines. Even though more homes are available, the hesitancy to purchase is palpable.
According to the data, residential sales in May were down by 9.3% year over year and 26.2% less than the 10-year sales average for the month. This decline is across various property types, including detached homes, townhomes, semi-detached homes, and condos.
Yes, and while prices for most property types have decreased compared to last year, townhomes did see a slight month-to-month increase. But even with these lower prices, the uncertainty seems to be a bigger factor influencing buyer behavior.
Crystal Mora from the Cornerstone Association of Realtors highlighted that this cloud of uncertainty is largely driven by economic factors such as tariffs and job security concerns. These are making potential buyers hesitant to enter the market.
And with the Bank of Canada holding its key interest rate steady at 2.75%, some analysts were hopeful that rate cuts could spur buyers back into the market. But it seems the current economic climate is causing more trepidation than optimism.
Exactly, Janine. The local home inventory is actually climbing, with a 1.4% increase in new listings compared to last year. Despite this, homes are taking longer to sell, averaging 24 days on the market, which is significantly longer than the 5-year May average of 14 days.
It's not a lack of buyers or inventory that's the issue. It's the lack of consumer confidence. As Maura mentioned, consumer confidence is not at the level needed to drive stronger home sales, and this is a crucial aspect of the current market dynamics.
Absolutely, Janine. As we wrap up today's episode, it's clear that the real estate market is in a delicate position. While there are opportunities present with increased inventory and competitive pricing, the broader economic uncertainty continues to weigh heavily on buyer confidence. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.